The Rebel Capitalist Show. All right, guys, it gives me a great deal of pleasure to bring someone to the Rebel Capitalist Show that I have a tremendous amount of respect for. She is my mom's favorite macro thinker, and that is saying a lot. Her name is Juliette Declercq. Juliette, welcome to the Rebel Capitalist Show.
Thank you very much for inviting me. And, I know we were overdue for a while, but, I didn't really want to be talking about coronavirus. So I think it's a good opportunity now to not talk only about that. And to be honest, like the last 3 months have just been unbelievable, like macro-wise. And that's kind of the thing that's been keeping me up and going in the lockdown. Basically to be able to come out with all these exciting thoughts and trade ideas for clients. So, it's been ups and downs, but for the macro world, I think it's been definitely up.
Yeah, well, there's a lot to talk about, that's for sure. We first, I guess we met at, I guess you could say that, at Macro Voices Live in 2019, where you were there with a group of people. We were all in Vancouver, Canada, and that was just a phenomenal event. You were one of my favorite speakers, so I've really been looking forward to this for a long time. For some of my viewers who might not be familiar with your background, Juliette, can you get us caught up with that?
Yeah, of course. I mean, I've got about 22 years of background, both in investing and in strategy. What I'm really excited about is not so much investing, but really advising clients and coming out with strategy. That's really what I'm in love about. And when people ask me why you're not trading, if you're as great as what people say,
Right.
well, really the answer is simply that I don't like trading.
Yeah. And most of your clients are institutional?
So most of my clients are institutionals, but I have a fair amount of high net worth that are also faithful clients and that I think I've been helping over the past 5 years. I started JDI Research about 5 years ago, and really my only goal is to help clients advance in the markets. My horizon is say from a few weeks to up to a year, and everything is based on the macro fundamentals, technicals, sentiment, really everything that is potentially going to impact market.
All over the world, yeah.
And I really pride myself in not being dogmatic at all, even if I can talk politics and on Twitter or actually my pieces are completely apolitic, because the only thing I care about is calling the market right.
Yeah, that's one reason why I really love talking to people in finance, especially people that are in research or they manage money, because when it comes to political views, they just can't afford to have a bias because they've got so much skin in the game, and you tend to get a very kind of equal approach or a balanced opinion from them, where they can kind of go back and forth on each side. And I really I enjoy talking to those people much more than the people that are extremely dogmatic, to your point.
And again, and that's exactly why I think you have to be right when you work for your own company. When I was in banks, I would be paid anyway, whether I was right or wrong, and it was just all about writing something interesting. But I can't afford anymore to just write something vaguely interesting. It's got to be to the point, otherwise my clients will leave.
Yeah. Okay. So on that note, yesterday you emailed me your last report, which was just fascinating. So we're going to kind of walk through that, because I think there's so many points that you could hopefully explain for my viewers that they'll really, really enjoy. The first thing, and I'm just going to read right off my notes here, is you talked about the most recent recession being very short-lived and having kind of a V-shaped recovery. And that contradicts a lot of kind of the main, well, not the mainstream thought, but the thoughts and opinions of the majority of the people I interview. So can you explain that? And then I don't know if you could go into that German indicator that you talked about. I found that very fascinating.
Yeah, of course. So firstly, on the economic recovery, what I've been talking about is a short-term V shape, but actually in the sort of like longer run, I'm more looking for like a U shape. And what I've been really talking about as well is a V shape / U shape economic recovery, which still leaves a lot of room for basically a V shape asset recovery. So if we basically focus first on economics, I think there's really two phases to this recession. So there's the one that's basically happening right now, which I've called a flash recession. So it's the deepest, but it's also the shortest on record. The fact is that for the first time in history of earnings, we've had to account for the downgrades straight away, instead of getting a slow drip of downward revisions, looking back at the actual losses. This means that in a matter of weeks, analysts were actually already back to looking for upgrades. So that's really like unprecedented. And we're going to talk about a lot of things that are unprecedented, but for me, that's really what's been driving markets. So in this first economic phase, we had income lost, through loss of employment, which was much more than fully replaced by fiscal programs. And we ended up with a staggering bounce in savings. I think we had the number in savings from like the income report last Friday, and I expected like the income to be replaced, but
Right.
what we actually got was like a 33% bounce year on year, which is just amazing. And if you want to share the chart that's in my report with some of your listeners, I'll be happy for you to do so.
Great.
But
I'll have the editors throw that up right now. Yeah.
I've got the chart at the bottom of the page, and I had to like basically put the whole page
Yeah.
for the savings.
Yeah. It's literally off the charts. Yeah.
Exactly. So in the meantime, we've got businesses that were largely kept on a loan drip and ready to thrive, to be honest, for like the COVID-19 winners. And which one I'm talking about, the Amazon and the Zoom of this world, largely like tech asset class.
Yeah.
And the ones that are getting ready to reopen for the COVID neutrals. So that's the first phase, really. And if you want to link that into assets, all we've done so far in terms of asset prices is basically revalue those COVID winners and the COVID neutrals in line with much looser fiscal and monetary conditions.
Right.
Now, that doesn't mean that I'm completely like ignoring the second phase of the economic backdrop. The second phase is of much greater concern, and basically the question that we need answered, and which I covered in the report that you read yesterday, but that I intend to look at a lot more in the next few months, is basically what part of these savings will be consumed. And as I said in this week's report, if the consumer, and especially the US consumer, does not consume, he will be losing his job. And that will potentially lead to depressionary trends. But the point is that it's not really the story that we're trading today. And it's something that you need to keep on the radar, but you need to always be trading what's actually happening.
Yeah. So, Juliette, do you think that's the connection point between Main Street and Wall Street? Because I think what you're talking about there, it's a lot of the corporations, it's a lot of the S&P 500, but it's maybe not so much the corner barber shop or the local cafe, something like that. So do you think that the determining factor for Main Street will be what people do with this money they're getting from the government? Are they going to put it into savings? Are they going to pay down debt, or are they going to go out and spend it? Is that it? Am I correct there?
And that's basically the second phase. So the first phase is basically revaluing the COVID winners, the large cap that quite frankly don't have any issues in terms of treasury, and basically the cyclical outlook, which we have started to reprice from last week. In line with global economic reopening. Now, you asked me that specific question about the IFO, which is it's a German survey, but for me, it's like the best way to look at what's going on in the world as a coincident indicator. The reason is that it actually surveys like 9,000 businesses in Germany. So we're not talking about analysts, we're talking about businesses here, and that's really the key thing. And obviously we all know that Germany is massively export oriented, but what's even more interesting is like Germany's exports are very well aligned with global GDP weight.
Oh, okay.
You look at Germany, you look at what businesses, exporters are thinking about in Germany, and you get a really good correlation between, their expectations and earnings growth for the MSCI world. And what I found by looking at the last IFO, which was from last week, is that we've now basically repriced in terms of earnings expectations for next year. So 12-month forward earnings, we're actually now in line with expectations from the IFO survey, which is telling me that the next phase is going to be not about still downgrading, but actually upgrading earnings. And that's really the key thing for the cyclical outlook to brighten a bit, if it's just only in the next few months.
Okay, so is it fair to say that you're actually bullish on the S&P, or is this more Euro-centric? Or I don't want to put words in your mouth.
I'm still bullish stocks generally, but
okay.
I find Europe is just exceptional value. But I think we're going to be going through that, in the rest of the of the questions. Yeah.
And you think Europeans is a better value because they're cheaper right now?
Yeah, much cheaper. When you look at what really drives assets, I mean, there's like a liquidity, but also sentiment. If you can find like an amazing amount of liquidity and an asset that everybody's been hating for the last 10 years, where just 10 days ago everybody was still looking for like a EU breakup and any trades to try and trade the EU breakup, then you will understand why we've actually gone up like 10% in the last 10 days.
Yeah, got it. Okay, so we might be going back a little bit here, but I want to stick with the format. Usually I just ask questions right off the cuff here, but your report was so fascinating. I want to make sure I stay organized. So the next thing that I saw there's you're talking about the growth of an economy having a lot to do with the labor force and then the productivity. And so can you expand on that and why you see that being so important, and then maybe how you see that playing out in the United States, Europe, Japan over the near term and long term?
Yeah. So an economy's potential is basically the growth of the labor force, which, unfortunately, there's not going to be much change to that. Like structurally in the US, we're going to like a growth of the labor force, which is going to continue sliding down to around like 0.5% in the mid 2020s. And you need to add that to productivity levels. So if you look at what the COVID crisis is going to do to the labor force, potentially we'll get a bit less participation. You might have like a skills mismatch between, say, the entertaining sectors, tourism sectors, and that might lower the participation rate. You might also see like some older people that decide finally to retire because they don't want to risk. They don't want to take risk on their health, and right. I think we've seen a bit of that, with teachers, and whether it's like in universities or schools. But there isn't going to be like, that's not really going to be moving the needle much in terms of potential growth. What really we need to talk about is productivity. So productivity in the last decades, with the advent of globalization, has been mostly about filling a growing gap in demand. And the way we've been filling this gap is basically by looking constantly for lower cost. So instead of looking for more clients, everybody has been just looking to produce the same goods, but at a much lower price by outsourcing productions and even sometimes services to emerging markets, and obviously, especially China.
Right.
So we've already been backpedaling pre-COVID. Part of the reason is simply that China is not as competitive as it used to be. And obviously, the trade war has been also, a move behind deglobalization. But I think what we need to consider in the post-COVID world is even more deglobalization. And there's two reasons for that. The first one is, I think we've all realized in the world that because of China's closures in February, there was like a great risk of not diversifying production.
Right.
That's one thing. But the second thing, and that's something you really see in Europe, is we're starting to see that there's a clear political move to reshoring. So reshoring is the new buzzword, and pretty much everywhere in Europe. And the reason is we've been basically like finding ourselves like short of PPE and medicine, and that's really been like the driving force. But quite interestingly, in France as well, there is like really added pressure on companies that are being bailed out. Like, for example, like Renault, to produce clean cars. And basically, President Macron has decided that actually clean cars is like a new strategic sector that he wants to protect. So like clearly a lot more protectionism. And I don't think this is going to be going away anytime soon. So that's basically potential productivity loss by like increasing cost.
And so we basically got a breaking down of global supply chains. Everything's coming back home. Here in the United States, people would say, okay, we want it made in America. We're sick and tired of China creating all of our pharmaceuticals, or India. And we don't, we had this COVID crisis and we didn't even have enough face masks for our nurses, our doctors, the people right on the front lines. We never want that to happen again. So we want all this manufacturing to come back home to the United States or to Europe. So what do you think that does long term? I'm talking about 5 years plus for consumer prices, because we've got the consumer that's really getting squeezed right now for obvious reasons. Are we going to potentially see consumer prices go up that could put them in more of a pinch, do you think?
So, I mean, that's exactly the question that we need answered. And the basic, probably like conventional wisdom would say that the consumer will pay for it, higher inflation. But what I'm saying is really not necessarily the case. And the crucial question is who will pay for this between, it could be profits, it could be the consumer, or it could be the government.
Okay.
And what's really interesting in this crisis is I feel more and more that we're moving away from GDP to GDW. So like looking for welfare rather than just money. I think one thing we've learned in this crisis, and I'm pretty sure you will share my sentiment on that, is that there is a lot of things that money does not buy. So
right.
Money doesn't buy freedom. I mean, you told me that you were stuck, where you don't really want it to be you didn't really want to be in the medium term.
I'm getting a haircut today, Juliette. I'm so excited. It's going to be amazing.
Exactly. So money didn't buy us education. I mean, my kids have been at home for the last 3 months, and quite frankly, it's getting really hard.
Right.
Money doesn't buy us health, and money doesn't even buy us transport. I mean, I've been trying to get back to France, which I think I'm entitled to, but literally there's like one train per day, and I'm looking to go on a cargo like to Normandy.
And just to be clear, you're in London right now, correct?
Yes, I'm in London.
Okay.
So suddenly my money wasn't devalued by inflation, but it's devalued because the country where I live, or the region where I live, did not cater for the risk of a pandemic. Right. And I now see this going in reverse with greater consciousness about sustainability, social welfare. So the sums spent today actually will make a difference to future generations. E.g., we can actually spend and change things, and we can actually like say that we're doing it for the greater good. So right. I think that's the time where we can actually make sense of why it will be financed with what I'm going to call like war bonds. Like war bonds are basically like bonds that are never going to be repaid. The best case scenario, there would basically be perpetuals that would be basically bought by the Fed or by the ECB. At the moment, we're only talking about quasi-monetization, but the point is like your debt to the GDP ratio is going to go up like potentially like 20% from here. But with central banks keeping real rates really depressed, you can actually finance this debt easily, assuming that you get a higher real GDP growth. Basically, what we're going to spend today is not going to be turning into higher taxes in the future. And it will basically disappear because there's no inflation and because we're looking for more inflation. So that's the reason why there is a sort of a free lunch at the moment, as long as we can justify it, for future generation and in terms of like achieving something that make you and me happier without more money.
Right. Okay. So let's unpack that, because there's a lot in there that is hard for me to get my head around. I'll be honest. So we're talking about government deficit spending, and doing this in a way that's going to be more beneficial for society at large. I totally understand that. But then you're talking about in this case, the Federal Reserve or the ECB, the central bank, monetizing the debt. They're basically printing the money, or they're printing the bank reserves, to be more specific, to buy the treasuries from the government so they can spend this money into the real economy. That will most likely increase M2, because when the government spends money, it increases deposits in the commercial banking system. I totally understand that. But if we don't have velocity going down at the same time, how is that a free lunch in the sense that it won't create consumer price inflation?
So, I don't think we know a lot about velocity right now. I mean, right now the US economy is closed. So anyone who is looking at like a collapsed velocity, well, you close the economy, velocity collapses.
Right.
The issue with like government spending in the past has been Ricardian equivalence.
Yeah, if you could go into that, because I don't know that most people are familiar with that economic term, and it was really, really cool.
So it's basically the thesis that once that any fiscal stimulus and the resulting increase in public demand, so like government spending, will eventually not matter because it will be fully offset by lower private demand. So there's two ways this can happen. Traditionally, it's normally because government financing pushes rates higher. So that basically increases the capital cost for private investment. And that's obviously one way it won't happen today because, basically the Fed and like every central banks have been promising that they will keep nominal yields low.
Yes, you're talking about pegging the yield curve. And let me just unpack that quickly so the viewer is following it. So what you're saying is that additional government spending usually makes, as an example, the 10-year go up, which makes mortgages go up. So that's less spending. So there's a counterbalance right there. Is that correct?
Yeah, and less private investment because the capital cost more.
Okay, got it.
This won't happen this time because central banks have been very clear that nominal yields are going to be pegged down, whether it's with YCC or like basically infinite QE. We will not see the curve steepen this time.
Okay, which we saw in World War II in the United States. I just want to be clear that this has been done in the US before, right?
Exactly, yeah. So that's really like an interesting thing. The second way and the most dangerous place right now is not through lower private investment, but through the consumer. So what can also happen is that the consumer starts tightening his belt because of expectations that this whole fiscal program will lead to a massive increase in taxes. And that's very much something that everybody's talking about in the United States. It's like the debt, and I think like all macro pundits are really looking at the debt as a problem in the future. Today, what I'm saying is this debt is going to be quasi-monetized through QE, and there's basically going to be no increase in capital cost because the big issue right now is just the enormous debt load, which potentially will be like, up to 20% of GDP, but it will not be repaid, and therefore it will not lead to higher taxes. And you can basically put it on central bank balance sheet with real yields lower than real growth forever. And if you do this, actually your debt to GDP ratio is going to start coming back down, and there won't be any debt spiral.
Okay, so so how does the debt to GDP come down there? I'm assuming that you're talking about taking the government spending, and as long as they're spending it on things that produce more goods and services, if the amount of goods and services is going up at the same rate, then it's not going to be deflationary, because then it's this race between M2, goods and services. As long as goods and services are outpacing M2, then it most likely won't be deflation or inflationary, excuse me. Is that what you're saying?
Exactly. And I think if you add that to a possible revolution to like more sustainability and more welfare, which would be like the reason for like the fiscal spending, then you could have like completely different consumption trends, which would be, more conscious about sustainability and generally future aggregate welfare. And I think you can really open a ton of new opportunities for investment in this business model, in this new sort of like a macro model.
Okay,
yeah.
So the government spends the money, the Fed monetizes it, but the government has to spend the money wisely. I think that's the big key here, and that's where I would be a little apprehensive.
I think that's where you really have to be at a stage where consumption is ready to change, is ready to like embrace the green revolution, willing to embrace more sustainability, willing to embrace not going back to like a place where you're basically stuck at home for like 3 months with your kids because the government hasn't been doing its job. But it's not the only part that is interesting in that.
Right.
There's another silver lining to that thinking. So we've been talking a lot about inequalities, and the problem about globalization has been all about producing at lower cost, but with a demand pool that's actually been shrinking because of a collapsing wage share. So wage share is basically the share of income that goes to wages rather than profits. The problem is like profits don't really consume. And so that's why we sort of like we're in a dead end where you just keep like growing profits, but with demand shrinking, in the end, you basically end up in a wall.
Yeah, and they've just been going to buybacks.
So exactly. And what we've completely forgotten about was like Ford, who was like presciently presciently thought in the 1920s that there is a limit to profits if the balancing act is basically low salaries, low employment, and effectively deficient final demand. So what I'm saying here is that a global move to less inequalities, and I think it's possible. What if we suddenly discover that the key workers are actually key, and we decide that they do deserve a wage increase? Then you have like you're basically unleashing a whole new pool of demand, because these poorer cohorts have a much higher propensity to spend than profits. So you end up with productivity gains that depend on economies of scale and focus on demand rather than always lower cost. So there's a potential here for a virtuous cycle for profits to eventually pick up again and go back to the levels that we were at, just by basically pushing for greater social welfare.
Yeah, if we were to execute that plan, I would much prefer that to be done from a bottoms-up approach as opposed to a tops-down approach. I would be very, and I'm not a professional, obviously. I'd be very hesitant if the government was forcing that upon businesses. But if the people demand it from a bottoms up, from the consumer level up, and then it just trickles up, let's say, into the corporate awareness, then I think it's definitely something that's interesting. I just get really concerned with the government creating all these new regulations and making it mandatory, and then you get all this misallocation of resources, you get unintended consequences, and then to me it might just create a worse scenario.
Yeah, I mean, I completely agree with you, but you know, there's some places which is, you know, where you look at like education, you know, healthcare and transport, where it's not going to be consumer led, right? I mean, what can you do to like basically incentivize your government to like, you know, care about education and not commoditize education or even healthcare like it is in the US.
Okay, so let's keep.
It needs to come from it would be ideal if it came from the consumer, but this is the sort of thing that, you know, can happen positive and come out of this crisis.
Yeah, so just to kind of summarize, what you're saying there is you do see areas where the government can play a role that is positive without them just being incredibly inefficient in making things worse. And I would love to talk about that for the next 2 hours, but we've got to keep moving along. But is that a fair summary of what you're saying?
Yeah, exactly. And you know, it's more an idea. The idea is more to accompany the consumer rather than just to force anything. But
yeah,
you know but if you can like basically move forward with the transition, and you know, if you've got a company that you know, makes things but not in a sustainable manner, and you know, consumers are pushing more and more for sustainability, and suddenly like you're getting help or like an incentive from the state to basically move everything to like a cycle that is sustainable, then suddenly, you know, you can have this, you can actually get productivity gains rather than productivity losses.
Okay, got it. So let's move on to the next question here. Yes, and this was really interesting because so many people think the bond market is smart and the equities market they're kind of lagging behind. They're in the corner with the dunce hat on, right? But you kind of have a different look at this right now, or a different angle. Can you explain that?
Yes, so I've heard a lot about you know, how equities make absolutely no sense, and fixed income are telling us that we're headed to a depression, and
Right.
so therefore there's a disconnect. I completely agree that there's a disconnect, but it's just the other way around. So yes, fixed income tends to have leading properties near both equity market tops and bottom. But in the current environment, what you need to look at is not nominal rates. And the reason we shouldn't be looking at nominal rates is because of what we're hearing from the Fed, that they're thinking hard about targeting specific yields on Treasury as a way of ensuring borrowing costs stay at rock bottom levels. And that was just last week, basically. So what you need to look at is not nominal rates, but break-evens, inflation break-evens, and real yields. If you look at short-term real yields, and if we can continue trending lower in line with basically rock bottom Fed funds and recovering front-end break-evens, then market can start anticipating a recovery in real yields along the curve, and that basically will be that normally happens ahead of a cyclical recovery in earnings. And I've got a great chart in my report about that. But basically, we should not consider the nominal curve as a gauge, but the real curve. And if you look at the real US yield curve versus cyclical's outperformance, you will see that in 2008, the real curve bottomed about 4 months before stocks started to price a cyclical recovery.
Okay.
This is exactly the same. That's happening this year, and the exact same indicator. So it's a 1 year versus 5 year real yield curve that I'm using, has basically bottomed in March this year, and it's been trending higher ever since, and back to above lows that we've seen in 2019. So what this is telling you is that fixed income is anticipating a cyclical recovery, which until last week basically was not priced at all by equities. Equities have been going up, not on a cyclical recovery, but basically just on revaluing those COVID-19 winners and like basically valuation, lower real yields, on the back of the policy mix that we've launched quite globally.
Okay, so you're saying that the bond market and the stock market are actually agreeing more than it seems just by looking at it at the surface level because of potential Fed intervention in buying bonds, increasing the demand for those treasuries. And then at the same time, you've got to look at real inflation adjusted interest rates opposed to just nominal interest rates.
Exactly.
And when you consider those two factors, the bond market and the equity market are agreeing a lot more than it may seem.
No, actually, they're not agreeing, but the other way around. So if you consider the right real yield curve, then you basically find out that the bond market is pricing a cyclical recovery, but that the equity markets isn't. And that's really what led me to recommend like a cyclical stocks, which have been performing like extraordinarily since last week, just on the basis that equities were pricing no cyclical rebound and had just basically recovered on valuation. So phase one, valuation, phase two, cyclicals. Cyclicals was priced in fixed income, but it wasn't priced in equities. Most macro pundits are actually looking at the opposite, thinking, equities are pricing a massive cyclical rebound when like the curve, the nominal curve, which is as flat as a crepe, is basically pricing depression. So
okay.
It goes worse than, disagreeing that, there's a disconnect. There's actually a disconnect, but the other way around.
Okay, got it. And I want to make sure that my viewers are very clear. What's your time horizon here, Juliette, with what you're saying? Because I think that's so important. Just normal people and just average Joe and Janes like me, if we hear someone talking, we automatically take what they're saying and apply it to our own time horizon. Like my time horizon for my portfolio, 5 years, 10 years plus. So if I hear someone on CNBC that's talking about they're very bullish, I just assume they're talking about over the next 10 years, but they could be just talking about the next 2 weeks.
Yeah.
And so what's your time horizon for this?
So my time horizon in terms of like looking at cyclicals is a few months.
Okay.
If you're really looking to the 5-year sort of trend, I still think there's a more value in still looking for like defensives and tech stocks, which quite frankly, like basically act like duration assets. So I think there's like currently like a window of opportunity for a cyclical recovery. After this window of opportunity and like sort of like cyclical repricing, I'm still looking for like a nominal recovery, growth recovery that is globally going to be quite weak, which still suggests that you should be keeping in portfolio in the longer run equities that behave like bonds.
Yeah. How do you see a second wave or a potential second wave of COVID playing into this thesis?
I mean, you'd have to get out of the first wave before you get a second wave.
Yeah, right.
The way I see a second wave, and I see it from like a European, I think we will manage it much better. I think we've got like higher hospital capacity. We sort of like used to wearing masks. Like I think behaviors have changed. So I think I don't see a full lockdown at all being imposed on a second wave. I think much more likely you would see basically vulnerables being asked to stay home. But you know what? In the end, everybody is allowed to like make their own decision. And I think what really comes out of this crisis as well is like, now we know the risk. And, if you're above 75 vulnerable and want to stay home, stay home, increase your life expectancy. But I think there is also like a great emphasis in the Western world on freedom. And you know what, if you've got 5 years left to live, do you really want to stay like 6 months at home on your own? And so I really don't see the second wave as leading to lockdowns that we've seen in the last 2 months. And I think it's just going to be much more isolated, maybe isolating towns or regions, or like a certain cohorts of people. But I don't think we're going back to like full lockdown. That would be like a disaster for confidence and the economy as a whole.
Okay, got it. Now, moving on here, I know you were talking in your report about being a little more bullish on Europe and the European Union, but you think the release valve could potentially be the euro. So could you explain that to us?
So yeah, what we just discussed is the reason for the massive outperformance in European stocks since the French-German proposal for a green shoot of fiscal union. Why does it matter, that fiscal union? Well, quite simply, it unleashes the ECB's potential and is super bullish for European risk assets in the medium term, because we can finally stand on two legs, like monetary and fiscal, rather than just a broken monetary leg. And the reason I'm saying broken is that with rates deeply negative, you're effectively in a monetary trap unless you can count on your fiscal leg or your fiscal agent to reflate and therefore lower real rates. So what's really happened with the French-German plan is not that it really makes a big difference for the macroeconomic outlook in the short term, but what it does is really completely change the medium and long term, where you now have a plan for any other crisis, any other like downturn. You now have a framework that is actually functional. And so you can now compare, somewhat you can compare the ECB and the Fed much more, they both have like potential. So I've been bullish on Europe for literally the past like 32% now. And to me, it's the one asset class with enormous potential still. Firstly, it's cheap. Secondly, the long-term fundamentals greatly improved over the crisis. You can almost say like it's like a COVID winner, to the same level as like Amazon or where you could actually see valuations move higher over the crisis, assuming the same sort of like cyclical recovery. But what's really like powerful for me is that everyone hated the asset class and was always ready to embark on EU breakup trades just a week ago. So when liquidity is flushing through global pipes like there's no tomorrow, which is what's happening right now, the assets with like long-term potential that everyone's loved to hate for a decade, as for me like the greatest potential. In terms of the euro, that's not really making me. I mean, there are some like narratives that suddenly you've got a fiscal union and therefore the euro will become more of a reserve currency. I think a reserve currency with like deeply negative rates, I'm really struggling with the idea, especially now the ECB can actually lower real rates even more. So, I mean, what we've given the ECB is a way to inflict even more financial repression. So, I think the wave of like euro buying that we're seeing right now is more of a knee-jerk reaction. But I'm not saying what's happened in the past 2 weeks as a major like euro revaluation force. I think it's just very positive for risk, but not for the euro.
Okay, so then let's go and address your outlook on the dollar. Can I assume by what you just said that you would be bullish the dollar on the DXY because it's kind of really heavily weighted toward the euro? And then what would your view be on gold, silver, commodities, and Bitcoin, if you've got views on those.
So, I mean, at the moment, basically everything is the same trade, and it's basically a risk liquidity trade. So when something like that happens, I try to always focus on the first derivative. How many times in your trading life you just looked at like equities going up and you just said, you know what, I'm going to pay a bit of rates, and end up losing a ton on rates because the real trade was equities. So for me, the dollar is more like a by function of risk. I think if the economy closes down again, we're going to see that the dollar go up. What's really been driving the dollar lower in the past week is basically like a rush for carry. So like, emerging markets greatly benefited. The whole LATAM revolved. But for me, it's really just like liquidity. It's a liquidity and carry trade. It's just like all this liquidity that needs to find a home before everything becomes negative. And I see much more value in trading that theme via equities rather than the dollar. So maybe we get to like levels where I feel comfortable we finally fully repriced equities, and I'll start to look for long dollar trades again. I think euro dollar is going to be caught in between those two trades. I mean, you can't really say that euro dollar is like a dollar trade, given like euro rates are like massively negatives. So I think it's just going to be kept in the range.
Okay, and then what about gold, silver, Bitcoin, commodities?
Gold, I'm still bullish gold. I think there's cyclical rebound going on right now. But after that, we're just going to go back to debasing currencies and sort of like FX wars, really, which suddenly the ECB can participate in. And I think basically everything is going to be like devaluing against gold. So I'm actually still recommending long euro versus gold. Bitcoin, the chart looks good. When I don't have a fundamental view, I look at the charts and I'm like, yeah, why not? It's for me, it's more of a like lottery ticket on a good chart. And I know I'm going to get a lot of pushback on that, but personally, I don't feel the urge to. I'm much more excited about stocks than Bitcoin. And what was the other one?
Oh, do you have an opinion on commodities, like
and
oil, uranium?
Is going to be like the antithesis of the dollar. So same thing, like but to a less extent. I mean, commodities are really going to get fully like sort of like revalued if we see the liquidity going from asset prices to the real economy, which is at the moment is not really a given. So, I would say probably like first thing, I like equities. Second thing, probably any currencies versus dollar with carry. Commodities, yes, but, on a tight leash. And Bitcoin, whatever, if you've got some spare cash and you fancy the chart. It's a good chart.
All right, awesome. Well, I've already kept you almost an hour, Juliette. I sincerely appreciate your time. For my viewers who want to find out more about what you do or reach out, where can they go to do that?
So they can check my website, or they can reach us straight on email through business@jdiresearch.com. They can also follow me on Twitter, but there's going to be a bit more political and hangs there or whatever.
It's a lot more fun too. I follow you on Twitter, and I can say that you are an incredible dancer. I mean, during this COVID thing, you guys did this awesome a music video with everyone in your complex, and it was really, really fun. I think it was Justin Timberlake, wasn't it?
Yeah, exactly. So yeah, I mean, actually some clients said they loved the video because they got to know me a little bit. And you know what? I mean, that's what I like about my business, is to get to know clients. I've got a very small mailing list compared to many macro pundits. I'm really focusing on quality rather than quantity. And I speak to any clients who want to speak to me, even on high net worth sort of like basic contracts. I also have premium contracts where I basically speak to the clients, like it will be like CIOs of hedge funds, but I basically speak to them every day. I put a lot of my heart in my research, and for me, like clients are incredibly important, and that's what I love about what I do.
That's for sure. Well, I can't recommend it enough, guys. Definitely check out her website, check her out on Twitter. And Juliette, again, I appreciate your time, and I just cannot wait to do this again.
Thank you very much for inviting me, and good luck getting out of Colombia.
All right, let's go get that haircut.